Technical indicators can be great tools for day trading if you know how to use them properly. But here's the critical point. They're not foolproof. Many factors affect how well they work, and adding more indicators to your charts won't automatically lead to better trades. In this video, we'll break down 3 of the most popular indicators used by day traders. You'll learn how they work, why they're useful, and see examples of them in action. Firstly, what are technical indicators? Think of them as mathematical formulas that analyze past price movements to help predict future trends. They can highlight trends, momentum, volatility, and other key market signals, helping traders make more informed decisions. But here's something important to remember. Indicators don't guarantee profits. They're best used as tools to support your strategy, not as a replacement for sound risk management or market understanding. Now, let's dive into our top 3 technical indicators for day trading. First up is the volume indicator. The volume indicator tells you how many contracts or shares are being traded within a specific period. It's a simple but powerful way to gauge the strength and conviction of price movements and reduce the chance of false breakouts. High volume usually represents stronger price moves, while low volume often signifies weak trends that might reverse soon. To confirm these price moves, if volume rises during an uptrend, it signals intense buying pressure. Conversely, if volume drops during a downtrend, it confirms that selling pressure is fading. You can also use the volume indicator to spot breakouts. A breakout with high volume is more likely to hold and continue in that direction. Let's see how you can use this in an example. Set up a 5-minute chart with volume bars and support and resistance levels. The price is consolidating near resistance while volume is low. Suddenly, the price breaks above resistance with a surge in volume suggesting strong buying interest. You enter a long buy trade right after the breakout and set a stop loss below the breakout level in case of a false breakout. Your target? The next resistance level or a trailing stop to maximize gains. Top tip: compare current and average volumes to gauge market interest and combine volume with price action and other indicators for more accuracy. Next up is the exponential moving average, EMA. The EMA is a type of moving average that gives more weight to recent prices, making it more responsive to market movements than a simple moving average. It's perfect for short-term trading because it smooths out price action, helping traders identify trends faster. Crucially, it filters out market noise for clearer signals. It works well with trend following, EMA crossover, support resistance, and scalping strategies. To identify trends, observe the movements of the EMA lines. If the EMA is rising, the market is in an uptrend, and if the EMA is falling, the market is in a downtrend. You can also use crossovers for trade signals. A bullish crossover happens when a short EMA, like a 9 period, crosses above a long EMA, such as a 21 period. Conversely, a bearish crossover happens when a short EMA crosses below a long EMA. Another way to use the EMA is to check momentum strength. Steeper EMA slopes indicate strong momentum, while flatter slopes suggest weaker trends. Let's try an example of an EMA crossover strategy for a buy trade. Set your chart to 5-minute intervals and apply a 9 period and a 21 period EMA. Wait for the 9 EMA to cross above the 21 EMA, suggesting a possible uptrend. Confirm the signal with additional indicators, like RSI above 50 or the MACD histogram increasing. Look for a slight pullback, where the price touches the 9 EMA as support. Enter a long buy trade at this point. Place a stop loss below the 21 EMA or recent swing low. Set your target at a previous resistance level or use a trailing stop for bigger profits. Finally, we have the moving average convergence divergence, MACD. The MACD is a momentum indicator that helps traders identify trend direction, momentum strength, and potential reversals. It's calculated by subtracting the 26-period EMA from the 12-period EMA. A 9-period signal line is then plotted alongside it to generate buy and sell signals. In addition to spotting trends and reversals, it also works well in both trending and ranging markets and reduces the risk of false breakouts. There are several ways you can use it, including MACD crossover strategy. A bullish crossover happens when the MACD crosses above the signal line, representing a buy signal. A bearish crossover happens when the MACD crosses below the signal line, suggesting a sell signal. You can also use it for divergence analysis. Bullish divergence is when the price makes lower lows, but the MACD makes higher lows, signaling a possible trend reversal up. Bearish divergence happens when the price makes higher highs, but the MACD makes lower highs, suggesting a possible trend reversal down. Finally, you could use histogram analysis, where rising bars show increasing momentum, while falling bars suggest weakening momentum. Let's try an example of the MACD crossover strategy for a buy trade. On a 5-minute chart, apply MACD lines, 12, 26, 9, and a 9 EMA for trend confirmation. The asset is in an uptrend, trading above the 9 EMA. The MACD line crosses above the signal line, signaling a bullish crossover, and the MACD histogram bars turn positive and start increasing, confirming momentum. Enter a long buy trade at this point and place a stop loss below the last swing low. Set your target at the next resistance level or use a trailing stop to maximize profits. Head to DayTrading-com/indicators for more insights on the best technical indicators for day trading and how to use them. If you enjoyed this video, let us know in the comments what you'd like to see next. And don't forget to like, share, and follow for more insights.